Welcome to Accounting with Pierre and Derek, brought to you by the Pierre and Derek Association.
This evening, we'll be walking you through three methods of calculating the cost of goods sold from an inventory that spans multiple years and purchases.
These methods include FIFO, first in, first out, LIFO, last in, first out, and the weighted average method.
Let's begin with a real-life problem. Pierre and Derek Association, or PDA for short, is a merchandising company selling Girl Scout cookies. Other than stocking inventory, PDA has no costs or expenses. They use Girl Scouts. In the year 2010, PDA bought 250 boxes of Girl Scout cookies for $200 each. In 2011, they bought 100 boxes of Girl Scout cookies for $100 each. In 2011, they sold 150 boxes of Girl Scout cookies for $250 each. These are really good cookies.
Question is, how much did PDA make in the year 2011? No matter the accounting method used, the gross income will always remain $37,500. However, depending on the accounting method used, the cost of goods sold will be different.
The first method we will cover is first in, first out, or FIFO. With FIFO, you calculate cost expense by expensing the oldest inventory first, hence first in, first out. So, in this case, PDA would expense 150 items from the 2010 purchase to find the cost of goods sold. Next, PDA would subtract the cost of goods sold from the gross income to get the net income of $7,500. Conversely, with LIFO, cost of goods expense is calculated by expensing the most recent purchases first, before expensing older inventory. In this case, PDA would expense 100 of the 150 items from the 2011 purchase, and the remaining 50 items would be expensed from the 2010 purchase. These values would be added together to get the cost of goods sold, and the cost of goods sold would then be subtracted from the gross income to get the net income of $17,500.
The last method we'll be covering today is the weighted average method. The weighted average method takes into account all of the purchased inventory. You take the total cost of inventory and divide it by the parts that make up the inventory to find the cost per item. In this case, the total cost of inventory is $60,000, and the number of Girl Scout cookies is 350. 60,000 divided by 350 gives us an average cost per box of $171. Therefore, the cost of goods sold is equal to 150, the amount of boxes sold, multiplied by the average cost per box, 171, giving us a net income, gross income minus cost of goods sold, of 11.7K. You may have noticed from the beginning that the market price of Girl Scout cookies deflated heavily between the years of 2010 and 2011. This meant that FIFO reported a higher cost of goods sold than LIFO did, while the weighted average method reported a cost of goods between the two other methods. This means that PDA would report the highest net income if it used LIFO. Just something to consider when you're deciding what accounting method your company is going to use.